Quantum computing is an exciting frontier in technology that harnesses the principles of quantum mechanics to process information. Unlike classical computers, which use bits for data processing, zeros and ones, quantum computers use qubits, which can exist as both 0 and 1 simultaneously thanks to a phenomenon called superposition. This ability allows quantum computers to perform complex calculations at an unprecedented speed. For instance, Google's Sycamore processor achieved quantum supremacy by completing a task in just 200 seconds that would take the world's most powerful classical computer about 10,000 years to solve. As we delve into this series on quantum computing and its impact on finance, you'll see how these revolutionary machines could transform industries from banking to trading. Next up, let's explore how financial institutions are already incorporating quantum technologies into their operations. Quantum computing is fundamentally different from classical computing. While classical computers use bits that are either zeros or ones, quantum computers leverage qubits, which can exist as both 0 and 1 simultaneously thanks to superposition. This allows quantum computers to process vast amounts of data much more efficiently than classical systems. For example, a quantum computer with just 50 qubits could theoretically perform calculations that would take the world's most powerful supercomputers thousands of years to complete. In finance, this capability is crucial for tasks like portfolio optimization and risk analysis, where handling complex datasets quickly can make or break investment strategies. Imagine being able to run millions of simulations in seconds rather than days. This speed and efficiency could revolutionize financial modeling and trading algorithms. As we delve deeper into how these technologies are reshaping the finance industry, let's explore some real-world applications next. Quantum computing is revolutionizing finance by solving complex problems much faster than classical computers. One key application of quantum algorithms in finance is portfolio optimization. For instance, D-Wave Systems has demonstrated that their quantum annealer can optimize portfolios with up to 100 assets more efficiently than traditional methods. Another example is risk analysis, J.P. Morgan. Chase has explored using quantum computing to assess market risks by simulating thousands of scenarios simultaneously. This capability could drastically reduce the time needed for financial institutions to evaluate and manage potential losses, making markets more resilient. These advancements highlight how quantum algorithms are not just theoretical, but have practical implications in finance today. As we move forward, let's explore some of the challenges and future prospects in integrating these technologies into mainstream financial operations. Quantum computing is set to transform portfolio management by drastically improving how financial analysts assess and optimize investment portfolios. Traditional computers can only process one calculation at a time, but quantum computers can handle multiple calculations simultaneously through the principles of superposition and entanglement. For example, J.P. Morgan. Chase has partnered with IBM to explore quantum algorithms that could potentially reduce risk in portfolio management by up to 20%. This means investors could see more precise predictions on market trends and asset performance, leading to better-informed decisions. Quantum computing can also speed up the complex optimization processes needed for large portfolios, significantly cutting down computational time from hours or even days to mere seconds. As we delve deeper into this technological revolution, the future of finance looks incredibly promising with quantum's capabilities in portfolio management. Next, let's explore how quantum computing is reshaping risk analysis in financial institutions. Quantum computing is set to transform risk analysis in finance by providing unprecedented computational power. Traditional computers process information sequentially, but quantum computers can analyze vast amounts of data simultaneously thanks to qubits and superposition. For example, J.P. Morgan. Chase has already used quantum algorithms to optimize their portfolio management, reducing the time needed for complex calculations from hours to minutes. In risk analysis specifically, quantum computing can simulate market scenarios with extreme precision, allowing financial institutions to better understand potential risks and opportunities. A study by Cambridge Quantum Computing showed that quantum algorithms could improve the accuracy of risk assessments by up to 20% compared to classical methods. As we move forward, this enhanced capability will be crucial for making faster, more informed decisions in finance. Next, let's dive into how quantum computing is revolutionizing trading strategies. Quantum computing is poised to revolutionize high-frequency trading by enabling traders to process vast amounts of data and make decisions in nanoseconds. For instance, J.P. Morgan Chase has already begun exploring quantum algorithms for optimizing trading strategies. In fact, a study by Goldman Sachs suggests that quantum computers could reduce the time needed to solve complex financial models from days or even weeks down to mere minutes. This means traders can execute trades faster than ever before, potentially gaining significant advantages in volatile markets. IBM's Q-Network is another example where they are working with financial institutions to harness quantum computing for trading. With these advancements, we're seeing a new era of precision and speed in finance that could redefine market dynamics. Next up, let's dive into how quantum computing can enhance risk management in the financial sector. Quantum computing holds immense promise for finance, but it's not without its challenges. One major hurdle is quantum decoherence, where qubits lose their quantum properties due to environmental interference. This can lead to errors in calculations and has been a significant setback. Another challenge is the sheer complexity of building stable quantum systems. For instance, Google's Sycamore processor, which achieved quantum supremacy, uses only 53 qubits, far less than what might be needed for complex financial computations. Additionally, the high cost and specialized expertise required to develop and maintain these systems can be prohibitive. Despite these obstacles, progress is being made with new materials and error correction techniques. As we overcome these challenges, quantum computing will continue to revolutionize finance, making it an exciting field to watch. Next, let's explore how financial institutions are already integrating quantum technologies into their operations. Quantum computing holds immense potential for revolutionizing finance in ways we're only beginning to understand. For example, J.P. Morgan Chase has already used quantum algorithms to optimize portfolio risk analysis, potentially reducing computational time from days to mere seconds. This kind of speed and efficiency could be game-changing. Another real-world application is in fraud detection. Quantum computers can sift through vast amounts of data at incredible speeds, identifying patterns that traditional systems might miss. Looking ahead, we're likely to see even more transformative changes. Quantum computing could enable financial institutions to perform complex simulations for market predictions with unprecedented accuracy, leading to better-informed investment decisions. As technology advances and becomes more accessible, the finance sector will continue to leverage quantum capabilities, fundamentally reshaping how business is conducted. Next, let's explore some of the challenges that lie ahead in making this vision a reality. Quantum computing is already making waves in finance through innovative applications. For instance, J.P. Morgan Chase has been exploring quantum algorithms to optimize trading strategies and risk management. They've found that certain quantum algorithms can reduce computational time significantly for complex financial models. Another example comes from Goldman Sachs, which has partnered with quantum computing firms like IBM to develop new approaches to portfolio optimization. According to a study by the Quantum Economic Development Consortium, quantum computing could potentially solve problems up to 100 million times faster than classical computers in certain scenarios. This speed advantage can be crucial for high-frequency trading and real-time risk assessment. As these innovations continue to unfold, it's clear that quantum computing is poised to transform how we handle financial data and decision-making processes. Next, let's delve into the challenges and limitations of this groundbreaking technology. Quantum computing is set to revolutionize risk management in finance by offering unprecedented computational power. For instance, J.P. Morgan Chase has already begun exploring quantum algorithms to optimize portfolio rebalancing and improve risk assessment models. Traditional computers can take days or even weeks to process complex financial data for accurate risk predictions, but a quantum computer could do this in mere seconds. This speed and precision are critical when managing large portfolios and ensuring financial stability. For example, a study by Goldman Sachs suggests that quantum computing could reduce the time needed for Monte Carlo simulations from hours to minutes, significantly enhancing decision-making processes. As we delve deeper into how these technologies can be integrated into everyday finance operations, it's clear that quantum computing isn't just theoretical, it's becoming a practical tool in risk management. Next, let's explore how quantum computing is reshaping algorithmic trading strategies. Quantum computing is set to revolutionize how we price assets in finance. Traditional models often struggle with the vast amount of data and complex calculations required for accurate asset pricing. Quantum computers, however, can process this information exponentially faster due to their ability to handle multiple states simultaneously through qubits. For instance, J.P. Morgan Chase has been exploring quantum algorithms that could potentially reduce the time needed to calculate risk factors from hours to minutes. This not only speeds up decision-making, but also enhances accuracy by considering more variables and scenarios. In another example, researchers at MIT have developed a quantum algorithm for pricing financial derivatives, which showed significant speed-ups over classical methods. As these advancements continue, we'll see a shift towards more precise and efficient asset pricing models. Next, let's dive into how quantum computing is transforming portfolio optimization. Quantum computing is poised to revolutionize not just traditional finance, but also the burgeoning world of cryptocurrency and blockchain technology. For instance, quantum computers could potentially break many of today's cryptographic systems that secure cryptocurrencies like Bitcoin and Ethereum. A study by Deloitte estimates that nearly 70% of financial institutions believe quantum computing will significantly disrupt their industry within a decade. This disruption stems from quantum algorithms capable of cracking encryption methods much faster than classical computers. For example, Shor's algorithm can factor large numbers exponentially quicker, posing a direct threat to the security of blockchain networks. As we move forward, it's crucial for tech education to adapt and prepare professionals with the skills needed to secure these systems against future quantum threats. Next, let's explore how quantum computing is reshaping risk management in finance. Quantum computing is revolutionizing how we detect fraud in financial transactions. Traditional computers struggle to process and analyze large volumes of transaction data quickly enough to catch fraudulent activity in real time. Quantum computers, however, can sift through vast amounts of data exponentially faster due to their ability to handle multiple computations simultaneously. For example, J.P. Morgan Chase has been exploring quantum algorithms that could detect fraud patterns much more efficiently than current methods. In fact, a study by IBM showed that quantum computing could reduce the time needed for complex financial analysis from days or even weeks down to mere seconds. This speed and efficiency mean we can catch fraudsters before they cause significant damage. As we move forward, expect quantum computing to become an essential tool in safeguarding our financial systems. Quantum computing is poised to revolutionize market analysis and prediction by leveraging its unique capabilities. For instance, J.P. Morgan Chase has already started exploring quantum algorithms to optimize trading strategies and risk management, which could significantly outperform classical methods. With the ability to process vast amounts of data simultaneously, quantum computers can analyze thousands of variables in real time, providing more accurate predictions than traditional systems. This could lead to a 20% improvement in portfolio optimization, according to some studies. Imagine being able to predict market shifts before they happen, giving investors an unprecedented edge. As we delve deeper into these technologies, the potential for quantum computing to transform finance becomes clearer. Next, let's explore how quantum computing is reshaping cybersecurity in the financial sector. Quantum computing is set to revolutionize the insurance industry by enabling more accurate risk assessments and faster claim processing. For instance, Lloyd's of London has partnered with quantum computing firms like Zapata Computing to explore how these technologies can improve their operations. One key area where quantum computers shine is in handling complex simulations that traditional systems struggle with. This means insurers could analyze millions of scenarios much quicker than before, leading to more precise insurance premiums and faster payouts. For example, a study by the Quantum Economic Development Consortium found that quantum computing could reduce the time needed for certain financial risk analyses from days or weeks down to mere minutes. As we move forward, this technology will not only enhance efficiency, but also help insurers better understand and mitigate risks in an ever-evolving world. Next up, let's explore how quantum computing is transforming the field of cybersecurity. Quantum computing is poised to revolutionize not just financial transactions, but also how we regulate and ensure compliance in the financial sector. For instance, J.P. Morgan Chase has already begun exploring quantum algorithms that could streamline risk analysis and compliance checks. By leveraging quantum computers' ability to process vast amounts of data at unprecedented speeds, regulators can potentially identify fraudulent activities much faster than current systems allow. A study by IBM suggests that quantum computing could reduce the time needed for complex financial simulations from hours or even days down to minutes. This means quicker detection of market manipulation and more efficient enforcement of regulations. With such capabilities, we're looking at a future where compliance is not just about following rules, but also leveraging advanced technology to stay ahead of potential risks. As we move forward, the integration of quantum computing in finance will undoubtedly reshape how institutions operate and interact with regulatory bodies. Quantum computing is poised to revolutionize financial forecasting by providing unprecedented speed and accuracy. For instance, J.P. Morgan Chase has already explored using quantum algorithms for portfolio risk analysis, significantly cutting down on computation time compared to classical methods. With the ability to handle vast datasets and complex calculations, quantum computers can simulate market behaviors more accurately than traditional systems. This means that in the near future, financial institutions could predict market trends with greater precision, potentially reducing risks and increasing profitability. For example, a study by Goldman Sachs suggests that quantum computing could lead to up to 10% improvement in portfolio optimization. As we move forward, integrating quantum technology into finance will not only enhance forecasting, but also transform the entire landscape of financial services. Next, let's dive into how quantum computing is impacting cybersecurity in the financial sector. Quantum computing is already making waves in finance by solving complex problems much faster than classical computers. For instance, J.P. Morgan Chase has been using quantum algorithms to optimize portfolio diversification and risk analysis, significantly reducing computation time. In another example, Goldman Sachs is exploring how quantum computing can enhance their trading strategies, particularly in areas like option pricing and scenario analysis. Quantum computers can process vast amounts of data simultaneously, which makes them ideal for financial modeling that requires analyzing multiple variables at once. This could revolutionize everything from fraud detection to high-frequency trading. As we move forward, the integration of quantum computing into finance promises not only faster computations, but also more accurate predictions and better-informed decisions. Next, let's dive into how this technology is being integrated into educational programs to prepare future financial analysts and traders for a quantum-driven world.